Welcome to the deep dive. Today we're tackling a really significant recent event, the collapse of Silicon Valley Bank.
Yeah, big one.
You've sent over some fascinating material, specifically excerpt from a YouTube video. It's called SVB Crumbling Connect the Dots Part 9 by Marantz Rantz.
That's the one. Quite a title.
It is. So our mission here for everyone listening is to kind of cut through the noise, understand the core reasons, and crucially, the connections that led to SVB's downfall.
Exactly. We're not just rehashing headlines.
No. We want to get into the underlying story.
Think of it as peeling back the layers,
Yeah.
going beyond just there was a bank run to look at the vulnerabilities, the whole chain reaction.
Okay, so let's start with the basics then. Who was SVB? They were headquartered out in Santa Clara, California.
Right, Silicon Valley heartland.
And they were actually a pretty big player, weren't they? Like 16th largest bank in the U.S.?
Yeah, not smart potatoes at all. But the really striking thing from that video and other reports is their niche.
Right, the focus. The material highlights just how dominant they were with deposits from small to mid-cap companies, startups mainly.
Immensely dominant.
Back in June 2016, they reportedly held almost 26% of that market. That's a huge concentration, isn't it?
Oh, absolutely. And that hyper-concentration in tech and startups you see, it meant their fortunes were just completely tied to that one sector.
Unlike a more diversified bank.
Exactly. Very few other cushions to fall back on when things, went south. The video mentions Roku had something like $450 million there.
Yeah, substantial amount.
And the estimates for uninsured deposits by March 10th were staggering, maybe $170 billion.
Wow. So most of the money wasn't FDIC insured?
A huge chunk wasn't. And that lack of a safety net for such a massive amount, well, it made them incredibly vulnerable if confidence dipped.
Which it clearly did.
And boom, the bank run on March 10th. That was the direct result of those fears, basically.
And it wasn't just a local California issue, right? The video points out SVB Financial Group, the parent company, operated nationally.
Yeah, California to Boston. So the ripples were always going to be wider.
Right, that national footprint. Okay, let's talk about how fast it all happened. The decline. The source highlights a jaw-dropping 60% collapse in their share value.
60%. Just gone.
After they announced a $1.75 billion share sale to try and, shore up the balance sheet?
Exactly. Try to plug the hole. But that doesn't sound like a minor wobble, does it?
No, it sounds like panic stations. What was behind that kind of dramatic drop?
Well, the share sale itself, that was a massive red flag, wasn't it?
Suggests they were struggling.
Yeah, struggling to raise capital through, let's say, less disruptive ways. And when a bank suddenly needs to sell a ton of stock like that, the market reads it as, uh-oh, they've got underlying problem.
And confidence just evaporates.
Instantly. And what's really interesting here, the video talks about their high loan-to-deposit ratio.
Okay, what was that?
Around 63% of their portfolio was tied up in loans. Big ones, too. Apparently totaling nearly $47 billion.
Is 63% inherently bad?
Not always, for every bank. But for SVB, with its reliance on those potentially, flighty startup deposits, it seriously limited their flexibility.
Yeah.
If everyone suddenly wants their cash back and most of your money is locked up in loans?
You can't give it to them, like having your savings locked in bonds when you need cash tomorrow.
Precisely. That's a great analogy.
Yeah.
So less liquid. And the numbers get even starker, don't they?
Yeah, the source says they had a negative cash balance. Almost $1 billion, negative $958 million. At the close of business on March 9th.
The day before the run really kicked off.
How does a bank even end up with a negative cash balance like that?
It just screams immediate liquidity crisis. It means more money was owed right then than they actually had on hand.
Wow.
And if you connect that back to the deposits, the video also details this significant outflow earlier, like a $25 billion drop between March and December of 2022.
So money was already leaving, even before the final panic.
Seems like it. A huge amount leaving in just, 9 months? Suggests the unease was maybe building among clients already?
Maybe worries about the economy hitting the tech world.
Could be. And it wasn't just deposits shrinking, according to the source. You also saw total loans increasing, business costs going up.
While assets were going down.
Yeah. Total investment securities dropped, total assets dropped. It really does sound like a multi-pronged financial squeeze, doesn't it?
It does, like pressure coming from all sides.
Exactly. These things aren't isolated symptoms. They're all interconnected. More loans, fewer deposits, strain on liquidity, rising costs, eats profits, investment losses. weakens the foundation.
Like a body with multiple organs failing.
That's a grim but probably accurate way to put it.
Okay, let's zoom out a bit. The broader market conditions. The video highlights a net loss on their investment securities in 2022.
Compared to a big gain in 2021.
Right, which was apparently boosted by things like the Coinbase IPO back then, so the whole environment shifted.
Massively. And that reflects the wider macroeconomic changes, interest rates rising, tech valuations coming down.
And their net income dropped significantly too, right? From like $2.7 billion down to $1.7 billion year over year.
Tells the same story. Tighter financial climate. But here's something interesting. The video points out their client investment fees actually increased in 2022.
Increased. How?
Well, the video suggests it was a direct result of the Federal Reserve raising short-term interest rates. Higher rates meant SVB could charge more on certain client funds or services.
Huh. So kind of a weird twist. The Fed's actions to fight inflation might have actually put more pressure on SVB's clients through higher fees.
That seems to be the connection the video is drawing.
Making it harder for those, maybe less liquid startups to manage their money.
It raises a really important point, doesn't it?
Yeah.
About how interconnected everything is. Fed policies have broad goals, but they can have these very specific, maybe unintended consequences for certain sectors.
And the banks serving them. It's a delicate balancing act.
Absolutely.
Okay, now the video gets into Spax and IPOs. This was apparently a huge source of fuel for SVB's deposit growth.
Oh, yeah. A major factor. Remember the SPAC boom in 2020, 2021?
Hard to forget. Felt like a new one every day.
Exactly. The video notes there were like over 400 in 2020, over 600 in 2021. Unprecedented numbers.
And all that money needed a home.
And SVB was right there, perfectly positioned. Their own filings, as the video points out, directly linked their massive deposit growth to clients getting liquid through IPOs, SPACs, VC funding, all that stuff.
So they rode that wave perfectly for a while.
For a while, yeah. It created this huge surge of cash flowing into the bank. They were right place, right time.
But like all booms,
Comes a bust, or at least a slowdown. The source notes a substantial decline in new SPACs in 2022 and 2023.
so that key funding pipeline for SVB's clients just started drying up.
Pretty much. And if your whole business model is basically built on that specific volatile trend.
You're setting yourself up for a fall when it reverses?
Exactly. When that spigot of easy funding turned off, the ones who'd grown used to it, like SVB and its clients, were the most exposed. The slowdown inevitably meant a big deceleration, maybe even reversal, of those deposit inflows.
Okay, now let's talk about something that always raises eyebrows in these situations. Executive pay?
Ah, yes. Compensation.
The video points out an increase in compensation and benefits expense in 2022, even as the bank was, starting to wobble.
Right. There was a dip in incentive pay, bonuses maybe, but it was more than offset by a jump in base salaries and wages.
And the commentator in the video, they don't mince words, do they? Calling it a dirty way of making money, implying executives were lining their pockets despite the problems.
Yeah, that's the implication drawn in the source. It certainly creates the appearance of a disconnect, doesn't it, between performance and reward.
Definitely.
When pay goes up as the company's health goes down, it raises serious questions about leadership priorities, and the timing here is key. This increase happened just as those underlying weaknesses were becoming more apparent.
What message does that send?
Not a good one. Suggests a focus on, well, maybe personal gain over the long-term health of the bank. That's how it can be perceived anyway.
And the video also highlights SVB taking on more debt, an extra $800 million in senior notes.
Yeah, adding to their existing $2.6 billion in unsecured senior debt.
Which feels like digging the hole deeper when you're already struggling, doesn't it?
Well, if you connect it back to the shrinking deposits and rising costs,
Yeah.
taking on more debt just further restricts your financial flexibility. It suggests they were maybe actively trying to plug holes in the dam.
But maybe not fixing the dam itself.
Possibly, without addressing the fundamental structural issues. It's a high-risk strategy, especially when interest rates are going up. Makes that debt more expensive.
And then there are the acquisitions. The video mentions buying Boston Private Bank and Trust in 2021 for $900 million in cash.
Right, and an earlier one, Lyrical Partners.
So given the increasing debt, do these acquisitions look like smart strategic growth now, or maybe overreach?
That's the million-dollar question, or rather the $900 million question, isn't it? Acquisitions can be good for growth, diversification, but as the video author rightly asks, shelling out that much cash for Boston Private, especially when you're already carrying significant debt.
It warrants a closer look.
Absolutely.
Yeah.
Did they potentially overpay? Did these acquisitions genuinely strengthen the core business or just add complexity and more financial obligations? Were there real synergies? Did they actually happen? Lots of questions there.
Okay, now the video pivots to leadership and board connections. And this is where it gets, well, really interesting, potentially messy.
Yeah, connecting the dots, as the title says.
The fact that the CEO, Greg Becker, sold $3.6 million in stock just, nearly 2 weeks before the collapse, that's going to attract scrutiny.
Oh, absolutely. The timing of that stock sale is undoubtedly going to be a huge focus for regulators, investigators.
Looks bad, at the very least.
Insider trading rules are there to prevent exactly this kind of thing, people with inside info profiting before bad news hits the market. Whether that's what happened or not, the perception is terrible.
It is. And then there's the unfortunate timing of Jim Cramer having recommended the stock earlier.
Right. A reminder that even the experts can get it wrong sometimes.
But the video also brings up Becker's past lobbying, apparently against stricter regulations for banks under a certain size. He argued the threshold should be higher.
Yeah, lobbying against the enhanced prudential standards for banks below $250 billion in assets.
Does that suggest anything about their attitude towards risk?
It's a valid question to ask. Regulations are there to mitigate systemic risk, right? Lobbying to operate with less oversight could be interpreted that way.
Not definitive proof it caused the collapse, but
it certainly raises questions about their willingness to operate under tighter controls, doesn't it?
Yeah. And the web of connections on the board itself is also quite something, according to the source.
Very interconnected.
You've got the current chairman, Kay Matthews, with a long history at Ernst & Young, a big accounting firm that's faced its own fines from the SEC.
Right.
And then board members with ties to huge players. Bank of America, BlackRock, McKinsey, various investment firms.
FTV Capital, Scale Venture Partners.
Even former high-level government officials like Mary Miller from the Treasury under Obama.
Yeah, Tom King from Barclays and Citigroup history, Allison Davis from BlackRock and McKinsey, Elizabeth Buzzy Burr with Morgan Stanley, Credit Suisse history. It's a who's who.
So what are the potential implications of having such a, tightly knit group at the top?
Well, on the one hand, that kind of interconnectedness can bring a ton of valuable expertise, diverse perspectives.
But the downside?
The potential for conflicts of interest, real or perceived. It always raises the question, were decisions made solely in the best interest of SVB's shareholders and depositors? Or might other relationships, other allegiances have played a role, even subconsciously?
And the video mentions people from Boston Private leaving SVB after the acquisition.
Yeah, several key figures apparently left after the former Boston Private CEO took over SVB Private. Hints maybe at integration challenges or different strategic visions. We don't know for sure, but it adds to the picture.
There's also a mention of John Langley, still at SVB, who previously worked at BlackRock and Citi. More connections.
The financial world is small at that level.
Now, the video even touches on the political leanings of at least one board member, based on social media, suggesting a certain, maybe left-leaning culture within SVB.
Right, the source brings that up.
And then speculates about potential political fallout, blame shifting related to the failure. This feels, it feels a bit like venturing into less concrete territory.
It does. And we need to be really careful here. This is what the source material suggests. We're not endorsing it.
Absolutely. Just reporting what's in the video.
Yeah, drawing conclusions based on individual political views is tricky. Establishing a direct causal link between someone's politics and the bank's collapse is usually highly speculative.
Especially in today's climate.
Exactly. These narratives pop up, but often lack hard evidence. It's important the listeners know we're relaying the source's perspective here.
Got it. Okay, the final parts of the video really tackle that critical issue. Contagion risk. Is this going to spread?
Right, drawing parallels to 2008. Lehman Brothers, Washington Mutual, Bear Stearns.
Scary comparisons. The commentator in the video sounds pretty skeptical about official assurances that, everything's contained, no wider impact.
Yeah, expresses clear skepticism.
Given what we know about how linked banks are, is that skepticism warranted? Should we be worried?
Well, look, given how interconnected the financial system is, some level of caution is always wise, isn't it?
Right.
Regulators move fast to try and contain the immediate fallout, yes.
Quite.
But the failure of a bank SVB's size can create ripples, uncertainty. The 2008 comparisons, while maybe extreme, highlight how quickly a loss of confidence can spread, how credit markets can tighten up fast.
And the video mentioned something about Wells Fargo putting out unusual communications.
Yeah, about potential inaccuracies in bank info. Adds to that sort of background hum of unease in the sector. People start looking over their shoulders.
And there was speculation in the video about bailouts, or maybe big banks swooping in to buy SVB's assets.
Yeah, the usual questions that arise in these situations. Who picks up the pieces? Does the government step in further?
And the video wraps up with a pretty blunt conclusion, doesn't it? Pointing the finger squarely at
Corporate greed as the primary driver.
Well, that's a strong charge.
It is. And while attributing a complex event like this just to greed might be an oversimplification.
You can see why people might think that.
Absolutely. The issues we've discussed, the executive pay, the potential conflicts of interest, the risk-taking, they certainly feed into that narrative for some observers. But ultimately, as we've seen, the collapse was likely, a perfect storm, a confluence of many factors, internal and external.
Okay. So as we wrap up this deep dive into the source material on SVB, it's clear this wasn't just some sudden out-of-the-blue event.
Not at all.
It seems like the culmination of a whole bunch of interconnected things. That heavy reliance on one specific sector tech startups fueled by SPACs and OPOs.
A sector that boomed and then busted.
Right. Then there was rapid expansion, followed by that sharp downturn. Questionable decisions, maybe, around executive pay and managing financial risk.
The strategy of growing through acquisitions, potentially taking on too much debt.
And those potential conflicts of interest on the board, maybe insufficient regulatory oversight based on that lobbying effort.
Exactly. By trying to piece these threads together like the YouTube video aimed to do, you get a much fuller picture. You see the vulnerabilities building up.
It wasn't just bad luck, was it?
Seems unlikely. More like a combination of strategic choices made when times were good that just proved disastrous when the tide turned.
This really just underscores how vital it is to look beyond the headlines, doesn't it? To understand the deeper connections, the potential motivations behind these huge financial events.
Absolutely essential.
So, considering all these interconnected factors we've talked about, what does the collapse of SVB really tell us about the financial landscape right now? About the risks that come with, rapid growth and these highly concentrated markets?
Yeah, big questions.
And maybe more importantly for everyone listening, what critical questions should you be asking now? About the stability of other financial institutions or maybe the specific sectors they serve, especially in light of what we've uncovered today? Something to think about.